Hi, this is Linda Hitt. We're going to look at the basic conceptual framework. We often think of accounting not having a lot of theory, but there's some. And this particular framework was developed by the Financial Accounting Standards Board and the International Accounting Standards Board together. So it guides general purpose of statements and then these characteristics, qualities, assumptions, and so forth that underlie financial accounting. So here are some of the things that were covered in this framework. Basic objectives, I think none of us would disagree with. If we're going to do financial reports, we'd like it to be useful to somebody, and certainly those who read it would be those who can either currently own stock or ownership in companies or plan to possibly become owners, and also those that lend money to companies, and maybe donors and other individuals. Anyone who wants to read financial reports, we'd like the information to be useful. The types of things people might want to know is, an investor might want to know, are they likely to make profit or return on their investment? How much risk are they taking on? And creditors may be very interested in terms of liquidity, the financial flexibility, how much debt do they currently have, how much equity financing, so they can get an idea if it's likely they're going to get their money repaid if they loan this company money, and certainly operating capability, how the company is faring and what prospects it could have in the future. We're going to spend a fair amount of time looking at the qualitative characteristics of useful accounting information. We'll go through each one of those principles or concepts, and we'll also look at accounting assumptions and principles and those various ones. So continuing, generally accepted accounting principles, or GAAP, basically is everything, rules, standards, guidelines that we expect companies to follow, and the auditors of their financial reports will make sure they do comply, and that will affect what kind of report the auditors come up with. All of this now, it used to be everywhere in different documents and so forth, but they finally figured out, I guess in 2009, that it would make sense to have one central online type system that you could search. And so now it's done by topic. So we have a codification project that is complete, and all the stuff that's US GAAP is on that. If it's not on there, it's not US GAAP. And certainly you have been familiar with financial reports. We've certainly looked in the past at balance sheet, income statement, statement of cash flows. We'll spend a little more time focusing in on the statement of shareholders' equity in the next couple of clips. And we sometimes forget to emphasize, but the verbal stuff is certainly just as important as the numbers. So management discussion and analysis, looking at the direction, evaluating the direction they've been in. You can learn certainly a lot from that, and then certainly footnotes and other things are important to make sense of the numbers. Elements of financial statements, you can kind of look at those. The accounting equation is the balance sheet. The revenue and expense, gain and loss is your income statement. Operating, investing, financing, cash flows is part of the cash flow statement. And then we have sort of a new deal. The comprehensive income includes the net income from the income statement, but plus some other things which we'll take a look at. And then what's going on with the owners? Are they putting money into the business, like we issue stock to them? Are we giving them dividends? Statement of retained earnings kind of picks a lot of that up. So anyway, so that's our basic framework, and we're again emphasizing qualitative characteristics and accounting assumptions and principles. Objectives, we've kind of briefly already talked about the objectives of financial reporting. Purposes, these different players need to know information. So all the statements all the statements help to provide the types of information that creditors, lenders, investors need to pick up and understand. So let's spend our time on, first of all, on qualitative characteristics. This is going to hopefully help with our accounting information. And at the very top of the list is decision usefulness. No one would argue that hopefully the main purpose of financial reporting is to give information that's going to be useful for investors, creditors, donors, readers of statements to make decisions. Basically that makes sense. And the thinking here is that there's two concepts with subconcepts. There's two major concepts, relevance and faithful representation. If we have a lot of both of those, then hopefully the information will be useful to making decisions. So relevance, and these are a little harder to get your fingers on. They're sort of general, broad statements, but if information is relevant, it's going to help a statement reader predict. So they can say, okay, this company, maybe is going to make a 10% increase in their profits based on what we've learned in the statements, or whatever the predictive is. Or the creditor may say, I predict that I will get my money back, I'll loan the money and I'll get it back in a year. And they'll be able to pay the interest. So information should help anyone predict the future. And then it should be information in such a way that you can actually look at your prediction, compare it to the actual what's happened, and be able to decide, did you meet that prediction or did you not? So the information really needs to help us with the basic feedback loop. You budget, you look at the actual, and you make changes. It's sort of that constant process. The information that's provided should at least include material items, which usually mean large enough that they will make a difference in our opinion. We can ignore some of the immaterial types of things. So relevance is kind of get the information to you when you need it in a way that helps you look into the future and say, okay, I will buy the stock because I think the company's going to do X. And then later be able to actually evaluate that decision with the information provided, using information that makes a material difference that's large enough to be worthwhile. So that's what you got on one side of the coin, and then the other part is how the information is presented, the representation of it. Faithful representation kind of means that the statements are transparent, that they really show us what the company is doing clearly, not a lot of lingo and language that covers up what they're actually doing. So substance over form means I don't care what you call it, what is it really? And we'll see some applications of this, like leases. Lease could be 100% purchase, but we call it a lease. So we want to make sure it's accounted for in the appropriate way. Things need to be complete, which usually means that the numbers are not enough. We need footnotes. You're using LIFO, FIFO, weighted average. Are you using straight line depreciation or double declining balance? So we need to get information like the footnotes. And we don't want it biased to any particular person's direction. So neutral would have us say that the data we have, this hasn't been tinkered with or juggled for somebody's benefit, or certain things picked out and done in a certain way, but it's not ethical, doesn't represent what the company really does. So we don't want the CEO to get or CFO to get a bonus by changing the report to benefit them. Accurate, I don't think any of us would argue we want things to be as free from error as possible, though probably, we have a lot of accounting estimates, as you probably already remember, so it's not perfect, but we want it the best that it can be. So at the very top, that's kind of the big charges that we've got. Come down the list a little bit. What would enhance the ability to have the relevance and faithful representation? Here are some other concepts that we find important. Again, focusing in on what group, what are the major players that use the financial report. So investors and creditors, well, do we buy stock in company A or company B? Do we lend money to company C or company D? Comparability is useful because if companies use the same accounting rules, particularly like in the same industry, it'd be easier for an investor to decide which stock to buy, for example, or which stock they're going to keep. So similar accounting methods within the industry, within a certain group of companies would be really ideal. Also, within the same company, over time, to be starting with LIFO, we know we're supposed to continue to use LIFO each year, unless there's a major reason that we make a change and the auditors have to support that change. So we can think about cross-sectional, within the industry, being similar, being the same, and time series for one company looking at trends. An investor would, want to be able to count on the changes in numbers not being because they changed accounting methods, but because the operations were different. Okay, so that would be particularly good to have a lot of comparability and consistency. Verifiability basically means that, two different people coming up with the information given in the statements would make a similar conclusion, that the results would be similar. So if, it looks like you're using LIFO based on your numbers, then somebody else tried it would actually show that you are using LIFO or straight line depreciation. Makes sense. Timeliness, we'd love to have the information to make our decisions when we need it. Granted, companies cannot do statements monthly and send them out to their owners, more than likely. They would not be as accurate because they couldn't be audited and checked and so forth carefully, but at least yearly and on the same cycle. So if you're on a calendar year this year, you're on a calendar year next year. Understandability, I think all of us would agree that if the data were given, the financial reports are given to people who are reasonably knowledgeable, if they studied it and took the time to really learn it, would it help them? Is it understandable enough? And, some of these footnotes and so forth are long and drawn out, so, there's some education certainly is needed to understand the reports, but it's important. There's one qualitative characteristic that they call cost constraint. I'm not so worried about the language of, what category it falls in, but just to understand the basics, what they mean. So this one is really a wonderful concept because it's the reality check. It's saying, hey, yeah, we'd like really good accounting information, but if it puts the company out of business to develop it, then what's the point? So benefits should exceed the cost of developing, and the Financial Accounting Standards Board actually looks at this every time they come up with a new pronouncement or an update to something else. So, yeah, we need to be able to look at the costs of developing this particular principle and also disclosing it. If we put financial data out there, well, maybe we really don't want our competitors to see that. So there is a cost of that as well, the disclosure. If something really is immaterial, it's not going to make a major difference in terms of a person deciding, making decisions on your financial reports. For example, small tools, if you add them all up and they're still a relatively small number compared to all the assets, then it doesn't make sense to set them up and depreciate them and take all that time and effort. Often small tools are simply expensed right away when you get them. And that's not going to hurt the financial statement reader, so it makes life easy. So we can cut costs in some cases for things like that. Okay, next, so we're sort of going down the hierarchy. We started with the top of the scale. Now we're getting down to some basics that are still important, but sort of are underlying, and sometimes they may be focused in one particular area. So reporting entity is an assumption that we have that basically makes sense. If you own 5 different businesses, you need to have 5 different sets of records, because how else are you going to be able to evaluate each of your businesses separately? So anything can be considered really a reporting entity. You could be a volunteer group, you could be a not-for-profit, you could be a profit-oriented, you could be talking about the state of Virginia, the country, the world. I mean, anything can be broken down to an entity. So whatever's important, you want to have the information broken down to that level so that you can make good decisions. And certainly if you're a sole proprietor, small business, you've got to keep your owner information, owner stuff separate from the business. So you don't want to commingle your private investments. Your interest revenue shouldn't show up on your business books and so forth. Going concern is, again, an underlying concept, which is sometimes reported as continuity, where we basically say, hey, we're going to be around. And because we plan to be operating in the future, it's okay for us to buy equipment and decide that it has a 5-year life, we're going to depreciate it over 5 years, because we plan to be here for 5 years. Depletion goes with natural resources, using up natural resources, and amortization goes with intangible assets, such as patents and things that have a limited life. So the adjusting entries that we do for property, plant, equipment, depreciation, and so forth are done because we assume that we'll be in business, and we don't really care about what the equipment would sell for today, because I don't plan to sell it. I plan to use it 5 years, and at the end of the 5 years I have a salvage value, and that will be my selling price. This is very different if you assume that you're going out of business, you're a quitting concern. Suddenly we don't care about running the business, we don't care about depreciating equipment, because we're no longer going to use the equipment. So now we do want to know what the current value is for each of these things. We're going to sell the assets off, go pay off the creditors, pay off the owners, and then go out of business. So it does make a very different focus, and this allows us to use historical cost, because we're just taking the price that we paid for something and expensing it over the time in which we benefit, in which we're able to use that asset to help us generate revenue. And that's okay, because we plan to be in business, where if we really weren't going to be in business, historical cost is not useful, because I need to know what it's going to sell for, and I'm not going to just simply expense it because of matching. Period of time, I think, again, is just a real basic, that we need data on a regular basis, which usually we require at least annually to go to investors and so forth. And we want to keep the same time frame. So obviously we wouldn't want a 12-month statement this year and a 13-month statement next year, because you couldn't compare, nor would we want a July 1st to June 30 statement this year, and then we're going to start and leave a couple months out and start with January and go through December. So we do want consistency in the timing and the amount of data months covered. Monetary unit, we obviously use the dollar. We assume that we don't have much inflation, which I think is pretty accurate in current times. So it's relatively stable, so we don't worry as much about the time value of money and those kinds of adjustments. And that's the last slide.